Good evening, class. My name is Anthony Channel. I'll be presenting on the closing process of temporary accounts to permanent accounts in an accounting period or accounting cycle, whatever you all know it as. The main three temporary accounts that we have been working with are dividends, revenues, and expenses. These are temporary accounts, meaning that at the end of an accounting period or accounting cycle, these three accounts have to be brought down to zero balance when you transfer them over to a permanent account. And permanent accounts, which aren't closed at the end of an accounting period, they just carry over from one accounting period to the next. So we'll give a brief definition. As I said, the permanent accounts are carried over from last accounting period to the next accounting period. And then this here is just a statement of cash flows that'll show you, different balances that you take that are temporary, and then you take those and put them into permanent accounts that'll go into your final financial statements. This is another example of a permanent account, the statement of stockholders' equity. This here is just an overview of the overall accounting cycle from start to finish, and it tells you everything like analyzing, journalizing, posting to ledgers, and preparing unadjusted trial balances and everything of that nature, so you can get to the closing process. And see, this here is just an overview of the closing process altogether. It gives you the main temporary accounts, revenues, dividends, expenses, and it says income summary because you take expenses and revenues and put them on the income summary, and you close the income summary to retained earnings. Dividends go directly to retained earnings. You don't put those on the income summary. And then it gives you permanent accounts, of course, liabilities, assets, shareholders' equity. You don't close those, as we mentioned before. You just take those and roll them over to the next accounting period. And then it just gives you recording and closing entries, close revenue accounts, the income summary, as I mentioned, close expenses, and income summary and dividends to the retained earnings. Then you have here, this is just an example of how you would close an account, debiting and crediting one thing. You close revenues with a debt to the revenue account and a credit to income summary. So it'll give you a brief example of the $25,000 going to the income summary, as you would do if you were doing a real financial statement of closing that account. So you see that, and then you close expenses with a credit to expenses and a debit to income summary. As you see there, the $18,000 goes to income summary, you debit it to income summary. Then we have here to determine the balance in the income summary account. You'll take you'll take 18,100. You'll subtract that from 25,000 to get 6,900. Then you take that 6,900 and put it to retained earnings, as you see there. Then you take the dividends, as we mentioned, straight to retained earnings. You don't put that on the income summary. So you see that right there, it's put on the retained earnings. And then you determine the ending balance in retained earnings, and it gives you your final balance for those three accounts that you close, those three temporary accounts that you close. So that will be the end of your closing process. And then from there you can go make a trial balance, etc., to see exactly if you got everything right. Like, this is just another overview of the accounting cycle. And it talks to you about a post-closing trial balance. There you go. And see, when you get to the end, that's how you know you have it correct. If your numbers match, you did your your arithmetic correct. And if not, you have to go back from the beginning and start all over. So, thank you. That's my presentation on the closing process. My name is Anthony Channel again. If you all have any questions, you can ask.